Hello and welcome to Market Domination Overtime. Stocks closing the day lower. Our very own Inez Ferre standing by with the latest market action. Inez.
Yeah, Josh, and right across the board, if you take a look at the NASDAQ composite down 1.7%, that's the lows of the session. The S&P 500 also down more than 1%, also ending at the lows of today's session. And the Dow Jones down almost 0.5%. Taking a look at the 10-year Treasury yield, that has been inching higher to 4.15. And then just looking at the US dollar, that's been going higher. That's also has put pressure on risk assets. If we look right now under the hood with the sectors, energy rebounding a bit, energy up today, real estate, but technology really taking a hit off of those Oracle shares that have been down because of AI funding worries. And if we look at the NASDAQ 100, you can see some of the damage that we're looking at here. NVIDIA down more than 3%, Alphabet, Tesla down more than 4% after Tesla closed at a record high yesterday. And you've got Broadcom, AMD that are down. In fact, I'm going to pull up the chip chart, the semiconductors chart here, and we'll see here red across the board, across semis, with Micron about to report its results, but also taking a look at software, as I mentioned, Oracle really being the decliner that has sort of cascaded these losses that we've seen today across the board. And then looking at crypto stocks, cryptocurrencies, Bitcoin down 2%. It had been up at around 88,000, 87,000 today, but just wasn't able to maintain those levels. Also, ETH down more than 4%, and crypto-related stocks also taking a hit today. But I'll tell you what didn't take a hit today, and that is commodities. If we take a look at, as I mentioned, crude oil up more than 2%, Brent crude also higher, and gold hovering near all-time highs, with silver futures also at all-time highs. These have been the outperformers year to date, and I'm just going to pull up the year-to-date chart so you can just see silver is up more than 100% year-to-date, 125% year-to-date. Gold up 64% since the beginning of the year, Josh.
All right, thank you, Inez. Appreciate it. Micron's first quarter earnings crossed the wire just moments ago. Let's get a quick check on these numbers for you. Q1 adjusted EPS, $4.78. Street was closer to $3.95. Q1 revenue, $13.64 billion. Street was closer to $12.95 billion. So beats on the bottom and the top there. More importantly, let's get to the guidance. Q2 EPS, $8.22 to $8.62. The street was at $4.71. And it looks like revenues here, they're calling for between 18.3 to 19.1 billion. Consensus was 14.38 billion. So that is a big beat. Gross margins, they're calling for between 67 to 69%. Street 55.7%. So beats there versus consensus. You won't be surprised to see that stock surging more than 5% here initially after hours. Keep in mind, this stock was already a rocket ship this year. It was up about 170% this year heading into the print. Despite that move, around 85% of analysts still say this one's a buy even after that move. Why do we care about Micron? Because it is the largest U.S. memory chip maker. Those chips go into a whole bunch of products. So think smartphones, PCs, data center. You get a read really on the health of those verticals, those end markets. One area of focus, of course, high bandwidth memory, HBM. That's a kind of chip that's needed for AI software training. Micron sells HBM. It's a higher performing chip. It's better pricing and margins. Investors have been very excited about that. Micron, at least initially here, they like what they hear in the after hours. We're up 5% here initially in response to that print. Well, for more, we're bringing in William Kerwin, Services Equity Analyst at Morningstar. William, the stock is up. That follows, as I said, a monster move in 2025 heading into this print. What do you make of the results?
Well, Josh, these are monster numbers in the guidance, as you said. It was not only a beat on the results they reported for their fiscal first quarter, but really this is a story about the guidance and just how much higher this pricing can go. And so the dynamics that we're seeing here is these are commodity-like chips. Memory chips can be produced by a lot of different players in the world, but there is a limited supply here. And there is so much demand for these chips to go into data centers for AI that it becomes supply constrained and then the prices just skyrocket. And so we think that's what's happening here in this really impressive guidance that drives revenue up. It also drives those profit margins to, frankly, ridiculous levels in the 60% range, as you said.
A key question, William, I know you talk about this in your research for this name, is how we think AI impacts DRAM and NAND cyclicality going forward. How do you think about that? As a financial analyst covering the name, William.
Well, we still think this is a cyclical market long term. The way that I've been describing it is that AI is creating this particularly strong, and especially as you look at the Q2 numbers, an exceptionally strong and particularly durable upcycle. But we still see it as part of a cyclical long-term end market. This is all about matching the ratio of demand to supply. And what we've seen over decades in the memory market is that when there are mismatches in that supply and demand, and you get into a period of oversupply, so if all of these memory chip makers start building capacity to fulfill this demand and they overbuild a little bit, that's when pricing can crater and really have the opposite effect of what we're seeing now, where growth and margins go severely down. So we don't see that happening in the short term, but long term, which is our focus, we still see this as a cyclical market, and this just being a particularly strong upcycle.
So if memory does remain cyclical, William, then pricing declines will return. How, as an investor, do I prepare for that? Or what signs and signals am I looking for to get ahead of that?
Well, that's exactly what we think, and it's hard to put an exact time on it, but we came into the print tonight a little bit bearish on the name, at least in terms of valuation, where we think if you're buying in at today's prices, you're really assuming that this environment where prices are going up rather than down, as well as demand going up, is going to last for a significantly long time. We think it'll last into the short term, but again, that longer term view of cyclicality keeps us on the sidelines for a name like this, at least heading into the print, and then we'll have to crunch the numbers tonight and see what comes out.
William, how do you think about the competitive landscape for Micron, Samsung, SK Hynix? How has it been shifting? What are Micron's advantages?
Those are the big three, and I described these products earlier as commodities, and that's really what memory chips are. So these are very advanced chips, but what Micron produces, what SK Hynix produces, what Samsung produces, generally we view as fungible, and these three firms being at similar paces of technological development. Now, you mentioned HBM earlier. That has been a slight paradigm shift in that dynamic where Hynix has really taken the lead, and we consider Micron to be a number two there. But longer term, we expect Samsung to make up its progress and again create this fungibility across the three firms. And that's what creates market-driven pricing dynamics, and those can lead to either a volatile cyclical downturn, or as we're seeing right now, really strong pricing that is benefiting all three of these firms.
William, Micron does have China exposure. What does that business look like long term?
Very little China exposure at this point, actually. They had taken a hit about a year or so ago by not being able to sell some of their products into China. So we see that exposure is actually quite negligible at this point. And again, most of the demand here is now being driven by AI data center buildouts in the West, both for HBM and their other versions of these DRAM memory chips.
What would be your top questions, William, for CEO Sanjay Mehrotra? What would you want to ask him if you get a shot?
Well, we want to know all about what they're seeing in the pricing environment, because this is a case where we were expecting pricing to be up, but nowhere near as much as it's guided to be up this quarter. And so I think what's on most investors' minds, what's on my mind, is the longevity of these pricing increases that I talked about, and really how long this amazing profitability can last, and if it can even go higher.
William, thanks as always for your time and that instant analysis. We appreciate it.
Thank you.
Coming up, we get a look at the latest consumer credit data from VantageScore next on Market Domination Overtime.
2025 has been a year of surprises. At the outset, many pros were doubting that year three of this bull market could match the outside gains of the prior two. but the AI trade, it keeps driving attention and driving behavior. And on today's Stocks in Translation, we're not looking at the best performers of 2025. We are looking at the names that you, the viewers, checked in on the most on the Yahoo Finance platform. And we're breaking down our top 10 trending tickers of 2025. So let's take a look at the scores on the door. And here we got the top 10 tickers. The first thing you might notice is that this is an AI-dominated list with maybe Bitcoin in the middle as the exception. Then you're going to see the perennial favorites, that's NVIDIA and Tesla to the left there. They are in a different zip code. Our NVIDIA quote page has a cool 250 million page views this year, while Tesla clocks in at over 180 billion. And while Apple is usually top 3, it was edged out this year by Palantir with nearly 100 million views. And from there, things stabilize as AMD, Amazon, Bitcoin, Meta, Supermicro, and Intel, they all clocked 40 to 60 million viewers each. Now, let's take a look at this list from a different perspective. This is our Yahoo Finance heat map, and we're looking at the box size right here. So each box size corresponds to the market cap of the company, and all of these are large to mega caps, with 2 in the $4 trillion bucket. That would be NVIDIA and Apple, all the way down to Intel over here at 180 billion. And in the far lower right, you almost can't see it there, you can see Supermicro, which is just shy of $20 billion. But the other thing you might notice is that the only losing ticker this year is Bitcoin, although Amazon is pretty close to break even too. So each of these has a different story. Now let's dive into some of the charts that really tell this story. And this is going to be a year to date. So we'll start with NVIDIA here. This has arguably been the poster child for the entire AI trade. And you can see it got kind of sucked into the post-Liberation Day redness there, but it has bounced back strong. It really hasn't done much over the last few months, but with 30% gains in a year after almost being up, 1,000% over the last 3 years. There you go, 963%. I think investors are going to take that. Now Tesla. Tesla's really interesting because over the last year, and this is a 3-year chart too, it has traced out a cup and handle formation. If it can break above 480, it has the ability to really break out, and 2026 could be the year to do this. If it fails at this level, well, maybe it's got to consolidate a little bit longer. Now let's take a look at Palantir. This stock is up 2,500% over the last 3 years. Let's dial down to a year to date. And you can see, like NVIDIA, hasn't really done much over the last few months, but still sitting on 140% year to date gains. Now, Apple, year to date, this stock is only up 9%, but it has come back nicely after it just kind of stalled out after the Liberation Day melee, where a lot of stocks were taking off. It was going sideways, but it finally caught up over the last few months. And so Apple has been generating recent record highs, even as NVIDIA has been going sideways. Now here's AMD to round out the top 5, 71% year to date. This is a very volatile stock, but again, I think investors will happily hold on to gains like that for a stock like AMD. Now, Amazon, barely positive for the year. This is a stock you kind of got to look at over this entire 3-year bull market. Still up 150%, but this was a year of consolidation. We'll have to see if 2026 breaks to the upside or the downside. And you know what? Bitcoin is a very similar story, sitting on more gains over the last 3 years, but this has been a year of consolidation. It happens to be down about 10% right now, and 75,000 is the line in the sand that I am watching. I think that gets hit before it takes off again. Then Meta, this is another 3-year story. Hasn't done much this year, but we'll have to see if it can continue the trend. 445%, very strong over this bull market. Getting towards the end here, Supermicro is a very volatile stock, and while it's up this year a decent percentage, you can see it was up a lot more in early 2024. So this is one of those high beta plays you got to trade with caution, but guess what? The Yahoo Finance audience loves to day trade this stock. And finally, here's Intel. This is another kind of sine wave pattern here. Let me just dial this down to year to date so you can see it has really taken off over the last few months. It's become a volatile stock, but it was doing nothing for the first 6, 7, 8 months of the year. So I think investors at the end of the day, at the end of the year, are going to be pleased with this one. So let us dial it back down here. I got a few things that are going to tell us what to watch in 2026. So just think of these as the questions that move these tickers. First is the AI spend payback test. Investors are going to want to see the revenue and not just the profits of these companies, not just the spending. And then next up is margins versus mega cap spending. Can these giants keep growing without the profit engine getting dented? Third, keep an eye on the chip cycle inflection point. Does demand for semiconductors, does it broaden out, or is it just stay limited to AI? Fourth, watch those crypto regulation headlines. 2025 was arguably the best year ever for crypto regulation, and Bitcoin isn't even positive, so let's see if sentiment can shift. And finally, monitor those rate cuts versus a real economy. If we get more cuts, ask why. Is it a soft landing scenario, or are we sinking into recession? Bottom line, these were the tickers investors just could not stop watching in 2025. Next year, what matters is whether the stories hold up, and that's where the rubber meets the road. And tune into the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
Current trends in consumer credit show some improvements among higher and middle income households, while lower income Americans are seeing delinquencies rise. That's according to the latest VantageScore data. Joining me now on this, we've got Rikard Bandebo, VantageScore Chief Economist. Rikard, always great to see you. So overall credit landscape, let's break it down by cohort, Rikard, at first. Start with the higher income households. Sounds like some improvement there in delinquencies. Why is that, Rikard? Is that income growth, it's rate cuts? What do you chalk that up to?
I think, first of all, it's a very good sign because we've been seeing since 2023 to the first half of this year that actually the higher income households, which are households with 150,000 earnings and above, had actually been seeing the highest relative increases. But since July, we've been seeing them not just stabilize, but also come down 3 of the past 5 months. And because they are responsible for so much spending, they have a huge impact on the economy. So seeing the fact that they are seeing their delinquency rates coming down should be a good sign for how the economy may be faring. So the reason that we are seeing improvements there is probably due to the fact that they have been able to see better income increases than other cohorts, and also they're perhaps being able to tap into other sources of equity, such as their home equity and other lines of credit, to be able to make sure that they're doing well.
All right, that's higher income. What are you seeing, Rikard, with middle income, lower income?
So middle income has come down. So in terms of it's still increasing, but the relative rate of the increase in the middle income is lower than it was in the first half of the year, which is a good sign. So they're seeing around about 3 to 5% year-over-year increases. But lower income is staying persistently higher at about 7 to 8, 9%. So they're now. So it used to be that for the past couple of years, lower income we're seeing less increases in the other two cohorts on a relative basis. But now lower income is remaining at that kind of 7, 8%.
How do you explain
whereas
that,
the others
Rikard?
have come down? So lower income households are, they don't have necessarily the same means. They don't have as many assets that they can, tap into when they're struggling with a monthly payment. So if they're suddenly hit with an unusual bill of some kind, they're the ones who will have the biggest challenge trying to handle that bill when that happens.
So that's breaking down by income cohort. Do you also, in the data, Rikard, do you have line of sight as sort of generational differences?
Yeah, we've been seeing quite a few movements in the generational side. Obviously, what you'd expect is that, for instance, Gen Z is seeing some of the highest delinquency rates amongst the different generational groups. However, that's been coming down. So it does seem like Gen Z has been able to adapt to the more challenging income environment that they're facing by living at home or just being much more careful with their spending. But reality is they've also been quite impacted by student loans, as have some other generations, and we're seeing that a lot of those households and consumers that are impacted by student loans have definitely also then reacted to those student loans by reducing their spending in other areas.
In terms of loan type, Rikard, what are some trends and themes that we should keep our eye on? Credit cards, personal loans, autos.
Yeah, so overall, we're seeing that consumer credit health is pretty stable, though we are expecting more households to struggle to make ends meet next year. As we look at, though, delinquency rates across different products, we're actually seeing that many of them are at their highest or near their highest they've been since just after the last financial crisis. So if you look at things like auto loans, they're definitely higher than they've ever been before. We're seeing student loans, since they resumed, are incredibly high. They're about double the average that they used to be before the pandemic. And then we're also seeing quite high rates in credit cards and personal loans. However, we are seeing that delinquency rates in mortgage and housing-related debt are still at a much lower level than they were in the 2010s.
Looking ahead, 2026, you expect delinquencies required to rise modestly. Why do you expect that rise there? I mean, is that weaker job growth, Rikard? Is that dwindling savings? What's going to be the driver?
I mean, we've continued to see this trend for the last several years, honestly, since about 21, right? And so we're not seeing anything in the economy that's going to take it the other direction. But we are seeing it stabilize, which I think is the good thing here. And the reason for that is, at the end of the day, households are dealing with a bit of a price shock they're still recovering from 22, 23. And so that's put pressure on their outlays. At the same time, the job market isn't as strong as it was. So there are definitely more households being impacted by both of those factors.
These delinquency trends and trajectories we're talking about, Rikard, how sensitive are they to the Fed's rate cut path next year?
So, we do think that it should help, particularly for instance, like mortgage. Mortgage affordability is obviously one of the things that's most talked about. It's the biggest outlay that many households have. Auto loans, obviously it'll have an impact as well, but you've got to remember with auto loans, when you buy your car, you signed up for that loan for a number of years, so most people don't tend to refinance those as much. But with mortgage, you may soon get to the point where it actually makes economic sense for many households to go and refinance. But also next year, there's a really good opportunity in housing in terms of being able to open up a lot more housing to first-time owners, which will be interesting to see how that goes.
Rikard, always great to see you, especially on set. Thank you, sir.
Thank you.
All right, now time for What to Watch. Thursday, December 18th. We're going to start off on the economy. Fresh inflation data coming out on Thursday with the November Consumer Price Index, or CPI. Remember, October's CPI report was canceled due to the government shutdown. Economists forecasting total and core CPI to come in at 3.1% and 3% respectively on a year-over-year basis. The report providing a key piece of economic data as the Fed charts the interest rate path going into 2026. And taking a look at earnings as well, we're going to be getting a big batch of earnings on Thursday, including Accenture, Nike, and FedEx. Nike announced the results for the second quarter after the markets closed. Analysts expecting sales to slip in the near term, with sales rebounding in the second half of the year as new products roll out and Nike leans harder into sports. And then inventory cleanup also continuing and expected to fall about 2.5% as Nike clears out excess stock of older merchandise. And moving over to housing, new mortgage rate data coming out from Freddie Mac on Thursday. The 30-year fixed rate mortgage currently sitting at 6.22%. That's up from the prior week and the first increase in 3 weeks. That's going to do it for today's Market Domination Overtime, but don't go anywhere. On the other side of the break, we have your outlook for 2026. Stay tuned.